Hello guys, and welcome back to Leah's Lifestyle. We're at it again with a Berkshire Hathaway, but this one's a little different. So in the 1983, there was Appendix about a goodwill and its amortization, the rules and the realities. And I asked you guys if you wanted me to read it, but I was going back and taking notes afterwards, like I always do, and I realized that this may just be important enough to make its own little video about. So for all those who are interested accountants or to getting to know the businesses a little bit more in depth and really understanding them, we are going to go over goodwill and its amortization, the rules and the realities in the appendix of the 1983 Berkshire Hathaway letter to shareholders. So without further ado, let's just read through this puppy. This appendix deals only with economic and accounting goodwill, not the goodwill of everyday usage. For example, a business may be well liked, even loved, by most of its customers, but possesses no economic goodwill. AT&T, before the breakup, was generally well thought of, but possessed not a dime of economic goodwill. And, regrettably, a business may be disliked by its customers, but possesses sustainable and growing economic goodwill. So, just for the moment, forget emotions and focus only on economics and accounting. When a business is purchased, accounting principles require that the purchase price first be assigned to the fair value of the identifiable assets that are acquired. Frequently, the sum of the fair values put on the assets after the deductions of liabilities is less than the total purchase price of the business. In that case, the difference is assigned to an asset account entitled Excess of Cost over Equity in Net Assets Acquired. To avoid constant repetition of this mouthful, we will substitute goodwill. Accounting goodwill arising from the business purchase before November 1970 has a special standing. Except under rare circumstances, it can remain an asset on the balance sheet as long as the business bought is retained. That means no amortization charges to gradually extinguish that asset need to be made earnings. The case is different, however, with purchases made from November 1970 on. When these create goodwill, it must be amortized over not more than 40 years through charges of equal amount in every year. The earnings account, since 40 years is the maximum period allowed. 40 years, what management, including us, usually elect. This annual charge to earnings is not allowed as a tax deduction and thus has an effect on after-tax income that is roughly double that of most other expenses. That's how accounting goodwill works. To see how it differs from economic reality, let's look at an example close at hand. We'll round some figures and greatly oversimplify to make the example easier to follow. We'll also mention some implications for investors and managers. Blue chip stamps bought Sears early in 1972 for $25 million, at which time Sears had about $8 million of net tangible assets. Throughout this decision, accounts receivable will be classified as tangible assets, a definition proper for business analysis. This level of tangible assets was adequate to conduct the business without use of debt, except for short periods seasonally. Sears was earning about $2 million after taxes at the time, and such earnings seemed conservatively representative of future earnings power and constant $1972. Thus, our first lesson, business logically are worth far more than net tangible assets when they can be expected to produce earnings on such assets considerably in excess of market rates of return. The capitalized value of this excess return in economic goodwill. In 1972 and now, relatively few businesses could be expected to consistently earn the 25% after tax on net tangible assets that was earned by Sears. Doing it, furthermore, with conservative accounting and with no financial leverage, it was not the fair market value of the investors receivables, or fixed assets that produce the premium rates of return. Rather, it was a combination of intangible assets, particularly a perversive, favorable reputation with customers based upon countless pleasant experiences they have had with both product and personnel. Such a reputation creates a consumer franchise that allows the value of the product to the purchaser, rather than its product cost to be the major determination of selling price. Consumer franchises are a prime source of economic goodwill. Other sources include government franchises, not subject to profit regulations, such as television stations, and an enduring position as the low-cost producer in the industry. Let's return to the counting in the Sears example. Blue Chip's purchases of Sears at $17 million over net tangible assets required that a goodwill account of this amount be established as an asset on Blue Chip's book, and that $425,000 be charged to income annually for 40 years to amortize that asset. By 1983, after 11 years of such charges, the $17 million had been reduced to about $12.5 million. Berkshire, meanwhile, owned 60% of Blue Chip and therefore also 60% of Sears. This ownership meant that Berkshire balance sheet reflected 60% of Sears' goodwill, or about $7.5 million. In 1983, Berkshire acquired the rest of Blue Chip in a merger that required purchases accounting, as contrast to the pooling treatment allowed for some mergers. Under purchase accounting, the fair value of the shares we gave to or paid Blue Chip holders had to be spread over the net assets acquired from Blue Chip. This fair value was measured, as it almost always is when public companies use their shares to make acquisitions, by the market value of the shares given. The asset purchased consisted of 40% of everything owned by Blue Chip. As noted, Berkshire already owned the other 60%. What Berkshire paid was more than the net indefinitely assets received by $51.7 million, and was assigned to two pieces of goodwill, $28.4 million to Sears and $23.3 million at Buffalo Evening News. After the merger, therefore, Berkshire was left with a goodwill asset for Sears that had two components: the $7.5 million remaining from the 1971 purchase and the $28.4 million newly created by the 40% purchased in 1983. Our amortization charge now will be about $1 million for the next 28 years and $0.7 million for the following 12 years, 2002 through 2013. In other words, different purchase dates and prices have given us vastly different asset values and amortization charges for two pieces of the same asset. We repeat our usual disclaimer: we have no better accounting systems to suggest. The problems to be dealt with are mind-boggling and require arbitrary rules. But what are the economic realities? The reality is that the amortization charges that have been deducted as cost in the earnings statement each year since acquisition of Sears were not true economic costs. We know that because Sears last year earned $13 million after taxes on about $20 million of net tangible assets, a performance indicating the existence of economic goodwill far larger than the total original cost of our accounting goodwill. In other words, while accounting goodwill regularly decreased from the moment of purchase, economic goodwill increased in the irregularly but very substantial fashion. Another reality in the annual amortization charges in the future will not correspond in economic costs. It is possible, of course, that Sears' economic goodwill will disappear, but it won't shrink in even decreasements or anything remotely resembling them. What is more likely is that the goodwill will increase in current, if not in constant, dollars because of inflation. That probability exists because true economic goodwill tends to rise in normal value proportionally with inflation. To illustrate how this works, let's contrast a Sears kind of business with a more mundane business. When we purchased Sears in 1972, it will be recalled. It was earning about $2 million on $8 million of net tangible assets. Let us assume that our hypothetical mundane business then had $2 million of earnings also, but needed $18 million in net tangible assets for normal operations. Earning only 11% on required tangible assets, that mundane business would possess little or no economic goodwill. A business like that, therefore, might well have sold for the value of its net tangible assets, or for $18 million. In contrast, we paid $25 million for C's, even though it had no more in earnings and half as much in honest to good assets. Could less really have been more, as our purchase price implied? The answer is yes, even if both businesses were expected to have flat until unit volume, as long as you anticipated, as we did in 1972, a world of continuous inflation. To understand why, imagine the effect that a doubling of the price level would substantially have on the two businesses. Both would need to double their normal earnings at $4 million to keep themselves even with inflation. This would seem to be no great trick. Just sell the same number of units as at double earlier prices, and, assuming profit margins remain unchanged, profits also must double. But, crucially, to bring that about, both businesses probably would have to double their normal investment in net tangible assets. Since this is the kind of economic requirement that inflation usually imposes on business, both good and bad, a doubling of dollar sales means correspondingly more dollars must be employed immediately in receivables and inventories. Dollar employment in fixed assets will respond more slowly to inflation, but probably just as surely, and all of this inflation-required investment will produce no improvement in rate of return. The motivation for this investment is the survival of the business, not the prosperity of the owner. Remember, however, that C's had net tangible assets of only $8 million, so it would only have to commit an additional $8 million to finance the capital needs imposed by inflation. The mundane business, meanwhile, had a burden over twice as large, a need for $18 million of additional capital. After the dust had settled, the mundane business, now earning $4 million annually, might still be worth the value of its tangible assets, or $36 million. That means its owners would have gained only $1 of normal value for every new dollar invested. This is the same dollar for dollar result they would have achieved if they had added money to a savings account. C's, however, also earned $4 million, might be worth $50 million in value, as it logically would be on the same basis as it was at the time of our purchase. So it would have gained $25 million in normal value, while the owners were putting up only $8 million additional capital, over $3 of nominal value gained for each $1 invested. Remember, even so, that the owners of C's kind of business were forced by inflation to ante up $8 million in additional capital just to stay even in real profits. Any unleveraged business that required some net tangible assets to operate, and almost all do, is hurt by inflation. Businesses needing little in the way of tangible assets simply are hurt the least. And the fact, of course, has been hard for many people to grasp. For years, the traditional wisdom, long on tradition, short on wisdom, held the inflation protection was best provided by businesses laden with natural resources, plants and machinery, or other tangible assets. In goods we trust. It doesn't work that way. Asset-heavy businesses generally earn lower rates of return, rates that often barely provide enough capital to fund inflation needs of the existing business, with nothing left over for real growth, the distribution to owners, or for acquisitions of new businesses. In contrast, a disproportionate number of the great business fortunes built up during the inflationary years arose from ownership of operations that combined intangibles of lasting value with relatively minor requirements for tangible assets. In such cases, earnings have bounded upwards in normal dollars, and these dollars have been largely available for the acquisition of additional businesses. This phenomenon has been particularly evident in the communication business. That business has required little in the way of tangible investments, yet its franchises have endured during inflation. Goodwill is the gift that keeps giving. But the statement applies, naturally, only to true economic goodwill. Spurious accounting goodwill, and there is plenty of it around, is another matter. When an overexcited management purchases a business at a silly price, the same accounting niceties described earlier are observed. Because it can't go anywhere else, the silliness ends up in the goodwill account. Considering the lack of managerial discipline that created the account, under such circumstances, it might better be labeled no will. Whatever the term, the 40-year ritual typically is observed, and the adrenaline so capitalized remains on the books as an asset, just as if the acquisition had been a sensible one. If you cling to a belief that If you cling to the belief that accounting treatment of goodwill is the best measurement of economic reality, I suggest one final item to ponder. Assume a company with $20 per share of net worth, all tangible assets. Further assume the company has internally developed some magnificent consumer finances, or that it was fortunate enough to obtain some important television stations or original FCC grant. Therefore, it earns a great deal on tangible assets, say $5 per share, or 25%. With such economics, it might sell for $100 per share or more, and it might well also bring that price in a negotiated sale of the entire business. Assume an investor buys the stock at $100 per share, paying in effect $80 per share for goodwill, just as it would a corporate purchaser buying the whole company. Should the investor impute a $2 per share amortization charge annually, $80 dividend by 40 years, to calculate true earnings per share? And if so, should the new true earnings of $3 per share cause him to rethink his purchase price? We believe managers and investors alike should view intangible assets from two perspectives. One, in analysis of operating results, that is, in evaluating the underlying economics of a business. Amortization charges should be ignored. What a business can be expected to earn on unleveraged net tangible assets, excluding any charges against earnings for amortization of goodwill, is the best guide to the economic attractiveness of the operations. It is also the best guide to the current value of the operations' economic goodwill. 2. In evaluating the wisdom of business acquisitions, amortization charges should be ignored also. They should be dedicated neither from earnings nor from the cost of business. This means forever viewing purchased goodwill at its full cost before any amortization. Furthermore, cost should be defined as including the full intrinsic business value, not just the recorded accounting value, of all consideration given, irrespective of market prices of the securities involved at the time of merger and irrespective of whether pooling treatment was allowed. For example, what we truly paid in the blue chip merger for 40% of the goodwill to seize, and the news was considerably more than the $51.7 million entered on our books. This disparity exists because the market value of the Berkshire shares given up in the merger was less than the intrinsic business value, which is the value that defines the true cost to us. Operations that appear to be winners based upon perspective 1 may pale when viewed from perspective 2. A good business is not always a good purchase, although it's a good price to look for one. We will try to acquire businesses that have excellent operation economic measures by 1 and that provide reasonable return measures by 2. Accounting consequences will be totally ignored. At year-end 1983, net goodwill on our accounting books totaled $62 million, consisting of the $79 million you see stated as on the asset side of our balance sheet, and the $17 million of negated goodwill that is offset against the carrying value of of our interest in mutual savings and loans. We believe net economic goodwill far exceeds the 62 million accounting number. And that's it, everyone. I hope you enjoyed that. Leave a link down below on your thoughts on this part, and don't forget to like, share, subscribe, hit that bell icon so that way you know every single time when I post. And until next time, bye.